This is Satya Pradhuman of Cirrus Research. The latest global report, the risk metrics, is just out. The title, U.S. term structure flashes concern, driving capital flows to discounted markets. In the last few weeks, there's been a lot of concerns about the inflationary fallout of the tariff struggles. The reality is that the term structure has shifted materially in just 6 months. Now what we're seeing is effectively a steepened yield curve. The irony, though, is that this is occurring in a time where just about everyone's forecast for a slowdown has picked up. And so what's going on here, there's lots of stories behind this, that it's tariff, it's inflation, it's sell America. The reality is that what's going on is a massive rotation because inflationary expectations are picking up. And as a result, a more valuation sensitive market is here. Effectively, we are breaking market leadership. When we look at the credit markets, we've also seen a more challenging period where you are moving from, in the last year or so, 30-year lows with high yield spreads, pretty much globally, with most key high yield markets, whether you're looking at Europe or Asia. We've seen the US spreads, for instance, move from like a 250, 275 handle going back to late last year, up to nearly basically 400 basis points. So clearly there is now a credit concern. That said, these levels, they're still benign in the longer term historic levels. Importantly, to no surprise, the fallout's been fairly dramatic. We've seen markets like Latin America, China, the UK outperform as the US has lagged sharply. Importantly, when we look at growth versus value, and I think this is really what we're trying to get at, is that if the term structure is hinting at a more inflationary backdrop, whether it's for nearshoring or tariffs, one way or another, that is an earnings-driven market. And as a result, value-driven strategies tend to work. If you look at the comparisons for most of the key markets, especially the US, we've seen a massive relative performance. Some of this, though, we're going to have to take with a grain of salt because it's effectively the Mag 7 selling down that's pulling down the growth benchmarks, allowing the value results to look better. But bear in mind, if we do have a market where you're getting a yield curve that's steepening and you've got inflationary expectations rising, then you are firmly moving into an earnings-driven market. Now, in terms of the fallout and the beneficiaries of this, when we look across to the way the market's moved, there's lots of stories behind it. It's sell America. What this is suggesting is that, well, wait a second. What people are doing is they're looking at lower multiples across the board. And so when we look at the US multiples, it's at historic highs, especially when you adjust it for just about every other key market, whether in Europe or in Asia. And so that valuation premium is what's really potentially being adjusted here. Importantly, if you look intra-US, same story. Large mega cap multiples are at record heights, and the rest of the system is actually fairly benign. So this adjustment could go on for a while. The reality is that if indeed we're moving into a challenging window where the supply chain continues to sputter, the margins of the large mega cap names, they're at historic highs in the US, and that's what in a good time acts as an accelerant for growth. And yet, if expectations are slowing, these record high margins for the large mega cap names will act as deadweight loss in the period to come. Take a look at the full report, and as always, happy to take your questions.